After studying this module, we shall be able to learn the concept of equity share capital, determine the cost of equity share capital, know the different methods for calculation of cost of equity, analyze the advantages and drawbacks of each method, calculate the cost of retained earnings, understand the difference in cost of using internal capital, retained earnings, and cost of external capital, new issue, and solve practical illustrations. The Indian Companies Act categorizes the share capital of a company into two categories, namely equity share capital and preference share capital. In this module, we shall learn about the equity share capital. Equity share capital is also referred to as ordinary shares. It comprises of the funds raised by issuing shares in return for cash or other considerations. It includes paid up capital and reserves and surpluses. They are the real risk takers and caretakers of the company, and they enjoy the right of voting. There are many other rights which are granted to equity shareholders, like the right to receive dividend, to attend general meetings, and so on.
Dear students, we will talk about cost of equity today. The cost of equity is more difficult and challenging to calculate. As equity doesn't have an explicit cost, the cash flow streams associated with equity investments are not certain. A company doesn't pay fixed rate of return to its investors of equity shares, unlike the fixed interest paid on debentures or fixed dividend paid to investors of preference shares. Equity dividends vary from year to year. Also, there is no assurance of repayment at a fixed price when the investors want to dispose of their holdings. It's difficult to estimate the change in price of the share at the end of a particular period. But this doesn't mean that there is no cost of equity. There is opportunity cost of using equity as a source of finance. Equity shareholders expect to obtain a certain return on their equity investment in a company. The equity holders' required rate of return is a cost from the company's perspective, because if the company fails to deliver this expected return, shareholders would not be willing to hold their investments in the company and will try to simply sell their shares. This will put downward pressure on the share price of the company in the markets. Therefore, cost of equity is essentially what it costs the company to maintain a share price that is theoretically satisfactory to investors. Cost of equity can also be defined as a rate at which investors discount the expected dividends of the firm to determine the true value of the share. The cost of equity capital is higher than that of preference and debt because of greater uncertainty of receiving dividends and repayment of principal at the end of the holding period of investments.
There is an opportunity cost of using equity as a source of finance. Cost of equity can be defined as the rate at which investors discount the expected dividends of the firm to determine the true value of the share. The cost of equity is more difficult and challenging to calculate, as equity does not have an explicit cost. The cash flow streams associated with equity investment are not certain. A company does not pay fixed rate of return to its investors of equity shares, unlike the fixed interest paid on debentures or fixed dividend paid to investors of preference share capital. Equity dividend varies from year to year. Also, there is no assurance of repayment at a fixed price when the investors want to dispose of with their holdings. The cost of equity capital is higher than that of preference and debt because of greater uncertainty of receiving dividends and repayment of principal at the end of the holding period of investment. Let us now proceed to the methods of estimating the cost of equity. There are two methods which are most commonly used to estimate the cost of common stock: dividend valuation model, capital asset pricing model. Each method is different and relies upon a certain set of assumptions regarding the cost of equity. Each of them produces different estimates of the cost of common equity. To begin with, we shall first discuss the dividend valuation method, or DVM. This model was given by Myron J. Gordon of the University of Toronto. The model assumes that the value of a share is equal to the present value of all future dividends that it is expected to provide over an indefinite period. Thus, KE is the discount rate that equates the present value of all expected future dividends per share with the current market price of a share. Every model is based on some underlying assumptions. This model too has a set of assumptions. These are: the current market price of the share depends upon the expected dividends to be paid in the future. The initial dividend is greater than zero. The main objective of investors behind buying shares is to acquire a future dividend stream. All investors have homogeneous, that is, identical expectations of this future dividend stream. There is constant rate of growth in dividend per share. Investors can accurately measure the riskiness of the firm so as to agree on the rate at which to discount the dividends. The stock market is extremely efficient at pricing securities. Present value PV of dividend stream is equal to current share price, current market price of share. The equation for finding out cost of equity under DVM is shown here. From the equation, we can see that the cost of equity can be found by dividing the next period's dividend by the current market price of the stock, that is, the dividend yield, and adding it to the growth rate in dividend per share, capital gains yield. The model assumes that the initial dividend is greater than zero. For instance, a company's share is trading in the market at rupees 200 per share. Expected dividend is rupees 20. Growth rate in dividends is 4%. Flotation cost is 2%. The cost of equity can be estimated by substituting these values in the formula as shown here. In order to calculate the cost of equity using DVM, we need growth rate of dividends. The growth rate can be estimated using the historical data on dividends or from various websites that post analysts' forecasts of growth rates. Although DVM is a very sound technique of calculating the cost of equity, it is not free from drawbacks. The following are the limitations of DVM. The model fails to calculate the cost of equity if dividends grow at a variable rate. The model fails to calculate the cost of equity for those companies that do not pay dividend in the current period. In this case, D1 would be 0 and thus P1, or expected price, would be 0, which does not make sense. This model does not apply if growth rate of dividends is greater than the required rate of return on equity, because in this case, the model will calculate a negative stock price, which is not possible. The model requires current market price of the share, which is easily available for listed companies whose shares are traded in the stock exchanges. However, the stock price of a privately held company is not available and thus requires an estimate of the share price. Thus, DVM is not applicable for all the companies. DVM does not consider the risk as reflected in beta. Therefore, many financial managers prefer the capital asset pricing model CAPM approach for estimating the cost of equity. Let us now proceed to the capital asset pricing model. The CAPM describes the relationship between risk and expected return on a security. It assumes that the investors hold a diversified portfolio which eliminates the unsystematic risk because return on investments in this portfolio is not in sync with each other. They are negatively correlated. They do not move in the same direction at the same time by the same amount. Therefore, the only risk which is left in the portfolio is the systematic risk, that is, market risk, which cannot be diversified and is measured by beta. The basic assumptions of CAPM are as follows. All investors are rational and risk averse. They have common homogeneous expectations regarding the expected returns, variances, and correlation of returns among all securities. All information about securities is available to all the investors. There are no restrictions on investments. There are no taxes. There are no transaction or taxation costs, and no single investor can affect the market price significantly. They are only price takers. There is no restriction on lending and borrowing at risk-free rate.
Capital asset pricing model was developed by William Sharpe way back in 1964 and some contribution made by John Lintner in 65 and Jane Marsden in 1966. Their work was based on the foundations of modern portfolio management laid by Harry Markowitz in 1952. CAPM predicts the relationship between the risk of an asset and its expected return. It helps in the identification of different securities, and these different securities are individual asset or portfolio of assets as overpriced or underpriced by assigning values not exact to these securities. This would help in selection of securities to be included in the portfolio by the risk-averse investors. CAPM talks about the ex-ante returns, returns which are expected in future from an asset. And here asset is a stock, a share. This return shall compensate the investors for time premium and risk premium. Time premium is a compensation or reward for waiting as the current consumption of money value is sacrificed for the present or proposed to the future. It's compensation for the loss in value of money. This compensation should be at least equal to the returns on risk-free assets, as this is the minimum expected return that one can have from his investments. The risk-free assets are, however, subject to interest rate risk and inflation risk. They are free from default risk. Risk premium. It's a reward for assuming risk by the risk-averse investors. His desire for return increases with the increased quantum of risk assumed by him. The risk premium is nothing but the compensation over and above the risk involved in riskless assets. The risk premium increases with the increase in risk. In other words, higher the risk, higher the return, lower the risk, lower the return.
The CAPM formula states that the return on each risky security or portfolio is simply the sum of risk-free rate, compensation for time value of money, plus some risk premium for investing in the risky security, that is, compensation for taking on the additional risk above the risk-free investment. The risk premium is the return provided by the market less the risk-free return. Cost of equity is equal to compensation for time value of money plus compensation for market risk. The equation for finding out the cost of equity under CAPM is shown here, where KE is equal to cost of equity, RF risk-free rate, RM rate of return on market portfolio or average return on all the assets, RM minus RF is equal to market risk premium, beta is equal to beta coefficient, systematic risk. The components of the equation can be explained as follows. RF, risk-free rate. It is the return earned on investing in risk-free securities like government bonds. The interest rate on 91 days Treasury bills is often taken as a proxy for risk-free rate. Beta. Beta is a measure of systematic risk. It is also referred to as non-diversifiable risk or market risk. A beta of value 1 indicates that the company moves in line with the market. It is 1 for market portfolio. If the beta is in excess of 1, the share is an aggressive stock or it exaggerates the market's movements, while if it is less than 1, it is a defensive stock or is more stable. Sometimes a company may have a negative beta, for example, a gold mining company, as well, which means the share price moves in the opposite direction to the broader market. Zero beta signifies risk free investment. RM minus RF is equal to equity market risk premium. It is the excess of market return over the risk-free return. It represents the extra return expected by investors over the risk-free return to compensate them for taking extra risk by investing in the stock market over and above the risk-free rate.
Beta is a measure of systematic risk. It is also referred to as non-diversifiable risk or market risk. It is that component of the total risk which is attributable to market factors that affect all firms and thus it cannot be eliminated through diversification. For instance, interest rate changes, inflation or purchasing power change, changes in investor expectations about the performance of the economy and the political changes. It is a responsiveness of securities return relative to the returns of a broad-based market portfolio. Either how sensitive the securities return is to the changes in return of market portfolio. Beta measures the amount of riskiness of each security. A beta of value 1 indicates that the company moves in line with the market. It is 1 for market portfolio. If the beta is in excess of 1, the share is an aggressive stock or it exaggerates the market's movements, while if it is less than 1, it is a defensive stock or is more stable. Sometimes a company may have a negative beta, for example, a gold mining company, as well, which means the share price moves in the opposite direction to the broader market. Zero beta signifies risk-free investments.
An appropriate risk-free rate is required for finding out the cost of equity using CAPM model. These general guidelines can be kept in mind while choosing an appropriate risk-free rate. Use the yield on a long-term bond if you are analyzing cash flows from a long-term investment. For short-term investments, it is entirely appropriate to use the yield on short-term government securities, for example, yield on 91 days Treasury bills.
CAPM explains the relationship between expected return and risk. CAPM believes that in an efficient market, it is the systematic risk that is much more vital. Since the systematic risk cannot be eliminated or reduced through diversification, It demands proper management. On the other hand, the non-systematic risk can be reduced to zero through diversification. It is thus irrelevant for investors. Hence, it is a systematic risk for which investors are rewarded or compensated. Systematic risk is measured through beta. So beta is sensitivity of securities return to the movement in general market index or the market portfolio. CAPM describes that expected return of a security is linearly related to its risk, measured through beta. This means higher the beta, higher the expected return, and vice versa. The basic theme of CAPM is depicted through a straight line called the security market line. The individual securities and inefficient portfolios lie below the CML and are found all through the feasible region. There exists no linear relationship between the expected return and standard deviation, which are variances. However, there exists a relationship between the expected returns and their covariances with market portfolio. This relationship is graphically presented in the form of a straight line security market line.
Security market line is a graphical representation of CAPM, which shows the relationship between required rate of return and systematic risk. It plots the expected rate of stocks on the y-axis against beta on the x-axis. The intercept is the risk-free rate and the slope represents the market premium. The security market line is a useful tool in determining whether an asset being considered for a portfolio offers a reasonable expected return for risk. Individual securities are plotted on the SML graph. The securities lying on the SML are correctly priced. However, the securities above the line are undervalued because for a given amount of risk beta, they yield a higher return, and the securities below the line are overvalued because for a given amount of risk, they yield a lower return. CAPM approach has many advantages over DBM. It is simple to understand and use. It takes into account the risk associated with investing in equity and does not depend upon dividends or growth rate. The implication of this is that it can be applied even to those companies that do not currently pay dividends or are not expected to experience a constant rate of growth in dividends. CAPM approach is also not free from flaws. There are certain limitations of this model as well. These are: the calculation of cost of equity capital is based upon estimates which heavily rely on historical data. Now, whether the past trend is always a suitable representative of the future or not is a big question. Further, it is very difficult to gather the historical values for those companies which are not listed or whose shares are not publicly traded. The value of beta is not easy to calculate, and it also changes over time with the changes in market risk. It does not remain stable over time. Also, beta only proxies for the systematic risk. However, poorly diversified investors would be concerned with not only systematic but total risk. Estimates of beta can vary widely depending upon the market index and time period chosen. The model does not offer any guidance on the appropriate choice for the risk-free rate. Risk-free rate may vary widely depending on the treasury security chosen. It is also very difficult to assume the values for risk-free rate, market return, and systematic risk or beta for the future. It does not incorporate flotation costs.
Let us now move to discuss the concept of retained earnings. The portion of net profit distributed to shareholders is called dividend, and the portion of the profit that remains is called retained earnings. In other words, the amount of undistributed profit which is available for investment is called retained earnings. Retained earnings is considered as internal source of long-term financing, and it is a part of shareholders' equity. Generally, retained earnings is considered as cost-free source of financing. It is because neither dividend nor interest is payable on retained profits. However, this statement is not true. A shareholder of the company that retains more profit expects more income in future than the shareholders of the company that pay more dividend and retains less profit. Therefore, there is an opportunity cost of retained earnings. In other words, retained earnings is not a cost-free source of financing. The cost of retained earning must be at least equal to shareholders' rate of return on reinvestment of dividend paid by the company.
Retained earnings are a very important source of finance for the company. It is that portion of a company's earnings which are not distributed to equity shareholders as dividend. Although there is no explicit cost of using the retained earnings, but that does not mean they are free of cost. They are the dividends foregone by or withheld from the equity shareholders. There is opportunity cost associated with the use of these undistributed earnings because if they were in the hands of the investors or shareholders, they could have earned profits or interest on these by investing somewhere else at the same level of risk. Cost of retained earnings is the same as the cost of an equivalent fully subscribed issue of additional shares, which is measured by the cost of equity capital on the assumption that the firm is earning at least equal to the cost of equity KE on these retained earnings. So, the cost of retained earnings KR is approximately equal to KE. It is a little less than KE because of the presence of flotation costs while making new issue of capital, that is, KR is less than KE. For instance, a limited company is planning to go for an expansionary project for which it needs additional funds. The company has two options. It can either raise funds through fresh equity or can retain its earnings and use the same. The current market price is rupees 40 per share and the flotation cost is 5%. Expected dividend per share is rupees 2 and dividends are growing at a constant rate of 7% per annum. Let us find out the cost of external equity, that is, cost of fresh issue, and the cost of internal equity, that is, cost of retained earnings. The cost of fresh issue comes out to be 12.263% and the cost of retained earnings comes out to be 12% as shown here. It is important to note that the cost of newly issued stock is higher than the company's cost of retained earnings. This is due to the presence of flotation costs in case of fresh issue of share capitals. Let us now summarize what we have learned in this module. In this module, we have learned about the equity share capital and the two methods of calculating the cost of equity share capital, that is, dividend value method and the capital asset pricing method. We have also discussed the pros and cons of each of these methods. Further, we have also learned to calculate the cost of retained earnings.
The cost of equity is more difficult and challenging to calculate as equity doesn't have explicit cost. It involves an opportunity cost. Equity shareholders expect to obtain a certain return on the equity investment in a company, and if the company fails to deliver this expected return, shareholders would not be willing to hold their investments. The two methods which are most commonly used to estimate the cost of common stock: dividend valuation model and capital asset pricing model. The dividend valuation model, or what we call DVM, deals with the expected dividend yield and is based upon the assumption that dividends grow at some constant rate in future. The CAPM describes the relationship between risk and expected return on a security. It assumes that investors hold diversified portfolios, so they are require the compensation for time value of money and the compensation for undertaking market risk by investing in risky assets. Survey evidence indicates that the CAPM method is the most popular method used by companies in estimating the cost of equity. Retained earnings are that portion of a company's earnings which are not distributed to equity shareholders as dividends. Although there is no explicit cost of using the retained earnings, but that doesn't mean they are free of cost. There is opportunity cost associated with the use of these undistributed earnings, because if they were in the hands of the investors or shareholders, they could have earned on these by investing somewhere else at the same level of risk. The cost of newly issued stock is higher than the company's cost of retained earnings. This is due to the presence of flotation cost in case of fresh issue of share capital.